day after the State of the Union. It was a wild, wild State of the Union. And I got to tell you, it was a wild, wild start to the day. A strange ending to the week. I'm not even sure how to, matriculate it all when it gets down to it. The market has been up and down and slightly volatile, although the volatility index, VIX, our synthetic volatility index, doesn't seem to suggest that any of these things are really causing concern for investors. Yet I see more and more fear over the AI space, which is what I've been posting a lot more about on the social platforms. And certainly the housing market has been all the fodder. Last night's State of the Union certainly gave us some insight into what the executive branch is thinking as it relates to housing. And I'm not sure it's the best plan long term, but it's a plan near term to say nothing else about it. But before we get into all of that, welcome to the Higher Standard Live, everybody. I'm your host, Chris Nahibi, and this show is brought to you by the team over at Fridays. I use them for my GLP-1 microdosing as well as some NAD plus for longevity. If you're into health, fitness, nutrition, or just living a better quality of life, go to joinfridays.com, enter code HIGHER. You'll get a $100 discount off your first order. We'll get some love. You'll get some good things, and we'll all be better for it. So joinfridays.com, use code HIGHER. Let's get into the market, shall we? We always start the show with the status of the market, and there is no clear trend today, which I think is a healthy signal, frankly, based on the State of the Union last night and some of the uncertainties that we're seeing here. I think this is probably the most logical place for us to be. We're not seeing a defensive risk-off position like we saw just a couple days ago, but we're not seeing a tech-led growth run broad rally. However, the big low-hanging fruit here, if you will, is going to be that Nvidia does have earnings that come out tonight. We're going to see that on our AI model that we're going to talk through and show here in a little bit. On that AI model, you'll see that is top of the list as far as things that people are saying for indicative of the market goes. And if you're a believer in our new 60/40 being stock and bonds, or equities and bonds, that being the 80/20 QQQ and Bitcoin, then maybe this will be a really good run for you. Whatever you feel about the markets, whether you're a believer that tech is leading the way or should lead the way or not lead the way, we have it here for a reason. And the reason why is tech does tend to lead the market. And wherever we go in the future, we know that tech is going to be part of that situation. Love it or hate it, that's the world that we live in today. So I fully expect that the QQQ will continue to outperform the S&P 500 of gains in the future. And if you're buying Bitcoin as part of that 80/20 strategy, now may be a good time. And of course, anybody in Saeed's wet paper towel hand camp is going to go, oh, blasphemy. How could you say that? Bitcoin's been taking a bloodbath as of late. Yeah, it has. And I'm not sure I'm 100% of a believer at this point in time, but you can't deny something that's happened in the recent moments. Frankly, in the recent parts of the day, today, I've been watching this very closely. Are you ready? There is the Bitcoin numbers. It is up. I always forget to close the ad. It is up to 69,000. That's a $4,700 rebound. That is significant and notable movement in my mind. It looks like Bitcoin is making a recovery a little bit. What size? What paper towel hands is in the chat. What up, Vic? How you doing, chat? Is anybody else on? Let's see, on YouTube. I want to see if I fixed the restream chat. I don't think that I did. The chat's still not coming through. Let me see if I'm looking over here on YouTube. Yeah. Hey, Sai, do me a favor. If you're watching this, go over to YouTube real quick. Give me a comment. See if it comes through. I am not seeing it come through on the restream chat on our dashboard, which means I still got technical issues for the chat that I got to work on, but I'll figure that out later. That is the current state of Bitcoin, and it is a meaningful state. Let's go back to the market status real quick. So you can see how there being no clear mixed trend here. This to me tells me the market is considering or reconsidering its risk-off position. I still think the small caps are going to perform well. I think the people who are going to outperform this year are probably going to be the other 493 stocks in the S&P 500 outside of the Mag 7. I think the Mag 7 is going to have proof of concept issues, but we'll see what happens with Nvidia's numbers tonight. Natural progression here is the synthetic volatility index is back into heavy calm territory, better than normal, very calm. We're not seeing any volatility in the markets. Nobody's freaking out. It seems to be that even after the State of the Union, there wasn't any consternation that led to, I would say, an economic fallout. Certainly there's going to be some political conversations that happen as a result of all these things because there's a lot of inflammatory stuff. And shout out to Nancy Pelosi getting blasted last night. Could not have been happier than that. That's not a Republican or Democrat thing. That's just a me not liking insider trading thing, which we got to talk a little bit about later on in the show. Kalshi just banned one of Mr. Beast's boys for insider trading. That's a headline I didn't see coming. But how bad you got to be insider trading for Kalshi to ban you on insider trading when they have come out and said in recent weeks and months that insider trading might not be a bad thing? So you had to be doing something pretty naughty in my mind in order to go down there. Let's see who else is in the chat. Welcome to the new listeners. Welcome to everybody that's out there. There's multiple platforms we stream on. We stream on LinkedIn, YouTube, X, Instagram if you like the vertical format. As a reminder, all the stuff on YouTube goes to off our channel just for the algorithm purposes. So you can still use the link that you're watching it on now. However, if you want to watch it in perpetuity, you can not only use the link there, but you can go to X and LinkedIn where it's just in the feed constantly and you can always watch. Let's go to the liquidity position of the market. This is the St. Louis Fed's real-time data API giving you a look at where the market liquidity position is. We are still at a net liquidity drain of an incremental amount, which means we're still in this restrictive tense territory, so we're not flooding the markets with liquidity. Don't expect there to be much change on this until such time as we see some significant movement by the FOMC, which is largely held to believe that there will not be any movement coming up anytime soon. But just in case you want to see the actual numbers from somebody who's not me, from the people who actually report it, let me give you a screenshot view here. This is the CME Group Fed Watch tool. This is what we use to predict. There is a 98% probability of holding rate steady for the March 18th Fed meeting. Only a slim 2% chance of actually cutting rates. So this is a very, very heavily favored. This is generally not this heavily favored towards keeping rates flat. I think we've seen the Fed's Waller and some other people come out recently in last months and days talking about how they're going to likely hold rates. So don't expect a rate cut at the next Fed meeting, and don't expect the liquidity position of the FOMC to change here significantly until such time as we see some, differentiation in their Fed policy. And that does come down to a Lisa Cook decision. What happens there is meaningful for the White House's ability to get a 4-3 majority vote, assuming they all believe and support the president's decision that lower interest rates are the way of the future. That was part of the narrative last night. He said he wanted the older demographic to keep the value in the homes they've established and the younger demographic to have more affordable housing. His solution, without saying it directly, was to lower interest rates. And while that might be fine near term, that does not solve the prolonged period of interest rate deflation that we had that led us to the situation that we're in today, where low interest rates artificially inflated the home price value. There's a couple ways you can fix this. Home prices obviously coming down as a function of supply, certainly part of that. But wages going up meaningfully would be helpful there. But I'm going to show you how they haven't kept up and provide you some chart work, because I know you guys all like the chart work, to show you an example of where the fundamental problem here is. And it's a Monte Carlo-like analysis. Anybody who listens to this and goes, well, Chris, just make more supply. You're already seeing the builders pull back on permits, on housing deliveries. So you're not going to see a meaningful add unless you see more affordability from other places. And of course, rates are one of those affordability levers. But wages are a big part of that. We need to earn more. I'm sorry. It's going to make some W-2 employers unhappy, but that's just the fact of the matter. It's just where life is going. Now, companies are making more money than ever at 16% on average. So I think there's room to have that conversation. But since we've been talking about home affordability continues to be stretched, although we have seen some improvement here. This has not come from additional supply to the market. Supply constraint, as you notice here, is not the biggest limiting factor on affordability currently. It is a limiting factor. It's just not the largest factor. Interest rates have a tendency to move this way heavier in one direction or the other. Wages aren't going to go up, and home prices coming down is a result of this, not necessarily a focus on this. So here we have supply seems to be at near a balanced position. If you look here, it's just on the cusp of balance according to our modeling. However, you've got mortgage rate payment burden, mortgage rate pressure, and price to income ratio still very much in the stressed camp. As a matter of fact, the price to income ratio is stressed and everything else is strained. So I would call this a very heavily strained market from affordability, and that should come as no surprise if you watch this show at any regular cadence. Let's get into the forecast before we get into the sectors today. This is the week of February 23rd, so keep in mind this is 2 days into this. You've got some pretty interesting stuff, durable goods that came out, ISM manufacturing PMI. Next Monday will come out. Then we have JOLTS, which is one of the preferred metrics for labor and employment. We are seeing a pretty palpable uptick in people noting that the jobs numbers are disconnected from reality. And we are seeing some stuff, I'm going to show you the charts here, that suggests that AI is not something that to be fearful of in the future of taking jobs, that it's already doing that now. As a matter of fact, I'm going to go so far as to say this, and Mohammed Al-Rain believes this too, so again, I'm an idiot, smarter people than me out there, that there is a tangible and measurable disconnect between jobs and the market in a way that we haven't seen before, where you're getting specifically productivity. We're seeing more productivity and less demand for employees. That is AI. That is technology, even if you want to discount the AI narrative that everybody's talking about. So you have to accept this is a reality now. You have to look at this as measurable now, and you cannot ignore it anymore. My advice to all of you, whether you're young or old, is to embrace it, is to get involved, right? You can go to Claude and you can learn to vibe code. You can go to Claude and use it every day for your tasks to try to increase your productivity. The more productive you are and the more familiar with this technology you are, the more acclimated you will be for whatever comes next. It could be job creation, it could be job destruction. But just like the advent of the internet, if you were still sending letters vis-a-vis traditional mail for a prolonged period of time, you were the outdated person. This is going to be the same thing. So get on board, ride this train for as long as you can. And you might be saying, well, Chris, what are you doing? Talking all that smack, but what are you doing? I'm actually using AI on the show, which we're going to show here in a little bit. And we're going to show you how AI helps us be more proactive, helps me prepare less for the show and have AI tell me what's going on in the markets. It also helps us be truly independent and not have a political bias, because it's not us and our opinions that are drawing this information. This is just AI scraping channels. And then I'm also building a OpenClaw installation for the office on a separate Mac Mini install. So I will point this out. If you're in the space and you're like going, oh, well, I don't want to go down this whole AI agent path because this is the next evolution of AI. AI agents will then give way to AI communities, if you will, and I'm paraphrasing, but collaborative work of AI agents together, which is already happening. Then you have these clusters that are going to come together to be able to be even more powerful. And then truly, once you get the power in place, you're going to have AGI shortly thereafter that. I'm very bullish on AGI, artificial general intelligence, which is the same level of a human effectively, same level of human reasoning. I think that's already actually in place, but I don't think we have public access to it. I think that's coming relatively quickly here, and I think it's a real reality. I don't think, like a lot of people think, that it's going to happen in early 2030. I think it's happening late 2025, early 2026 at the latest, my personal opinion. But, the speed and cadence of evolution is important here. Let's get into the sectors. Okay, DR Horton, Lennar, Pulte, Toll Brothers, NVR, all down a lot, okay? This struck me as a bit of a surprise because the average 30-year mortgage rate is down today. And you might be saying, well, then what the hell? If rates have gone down, why is this not really improved? I think you're seeing a real big disconnect in the market now. And we've got measurable signs to point to this, to show us how this is actually happening. And I know, you want examples. I'm going to give you examples. Let's start with the most obvious here, okay? Let's go to the bond market. I'm going to go to the screen share here. The bond market here is showing the 10-year creeping up. This is the biggest proxy for the 30-year mortgage rate. You're going to see this creep up. You'll see the 30-year mortgage rate creep up. We saw the 30-year mortgage rate dip into the high fives, just below 6%. That was meaningful. The builders got rate traction as a result of that. Now we're seeing it jump back up here, and I think that's probably a reasonable expectation. To me, this tells me that we're seeing a little bit of a bullish trend again. And it's if you look back here at CNBC, you've got pretty much the whole bond market seems to be moving in a meaningful way in the U.S. anyway, I should say. So actually, let's go to crypto again one more time. You see crypto again, bullish. Bitcoin up to 69,000 still. Ether, Solana, everything's up here. So XRP, so everything's going back into the market. And we'll go back to the U.S. market here. And again, I show you this just to show you guys how you can check these same things by just going to CNBC and right at the top. Dow Jones, S&P, NASDAQ, Russell 2K, all up. VIX is down, right? So that's their fear gauge. Our fear gauge, we know the synthetic volatility index. Theirs going down means that you're in a less volatile environment, less fear in the market. Anything below 20 is good. It was approaching and just got above 20 a couple days ago. So now you're seeing it go into a calm market, which is, again, why our variant of this here shows you calm and shows the number increasing. That is how we identify that for our modeling purposes. So we are on a very similar path here. So DR Horton, Lennar, Pulte, Toll Brothers, NVR, they are rate sensitive demand, and rates seem to be going higher, not lower at this particular juncture. And the housing market is, we got some cheeky shenanigans afoot, if you will. And I know you're saying, Chris, what does that mean? You keep saying it. Normally, I break this stuff up and I put it, we'll go through all the sectors and we'll go through this stuff later. But I think for this purpose, I think what we'll do is we'll spend some time looking at some of this data to really show you exactly what I mean by it. So you have a meaningful recap in each sector on exactly what that means. And I'm going to show you some housing data here, which I think is important. I've been kind of getting away from the housing data the last couple of weeks just because I wanted to focus more on some other things. But this is a good chart here. This is the number of home buyers in markets fall to record low. Estimated number of U.S. home buyers and sellers actively in the market. And there's basically a 600,000 buyer shortfall. You've got 1.36 million buyers and you've got 1.961 million sellers. That's a 600K shortfall of buyers in the market, which goes to show you that that supply is going to start being corrected here, not because of additional deliveries to the market, but because there's just more of one versus the other. And this should, in theory, help affordability over the long run. Near term, you got to have supply get to the market, people not buy. So here's my worry point, right? If you have the buyers who've been sitting on the sidelines say, okay, rates are in the 5% handle again, now's my time to buy, you might see a spike up in the coming days and weeks of people who are locking applications now in the next 3 to 4 weeks, buying property, and then that reports out in about 30, 60, or even some cases 90 days because housing is a lagging indicator to the metrics. I hope for the overall affordability of the nation that this does not drive a meaningful change. And as a reminder, of the 60% of people who have mortgages on their home, 60% of them, right, have mortgages 5% or below. So we would have to get meaningfully lower to really jump and get people to refinance, in my mind, a meaningful way. I think a 5 handle at the height is not meaningful enough. But I've seen differing opinions from different mortgage outlets about how sub 6% rates could drive that traffic. But I think this uncertainty is why you're seeing the sector volatility here in the home builders, amongst many other things. So keep an eye on that as time goes by. I think it's going to continue to be volatile for the not too distant future, and we're going to see that drive up a little bit. Let's go into some more sectors here. Let's look at the banks. The banks are getting hammered the other day. I think they're going to continue to do well today. There you go. So yeah, so this is really credit conditions. I do have a worry over what commercial real estate will look like, particularly your Sunbelt region multifamily, your office space, your traditional retail. As consumer discretionary spending continues to get hammered, we're going to see some of that credit condition market deteriorate a little bit. But for right now, this seems to be okay. And I say for right now for a reason. Banks with exposure to student loans, which are generally not these banks, the GSIBs, are going to have some trouble. We have student loan delinquency at the highest it's ever been. And the cohort with the most delinquency, ages 50 plus, believe it or not. That's the biggest delinquency in student loans. A lot of people who believe that student loan forgiveness was going to happen. Well, yeah, that didn't happen. So that's what the biggest cohort of student loan delinquency is, believe it or not. But the banks, we've said that this is M&A season for the banks. This is going to be a good season for the GSIBs, in particular. Community regionals will be swallowed up as part of mergers. I think this is going to be a shining star in the economy for the next year or so. Commercial real estate REIT exposure. I think REITs might be okay, but commercial real estate, as we noted earlier, does seem to have some weakness in certain markets. And there's an inflection point that we're reaching with AI data center deliveries versus commercial real estate deliveries. So keep an eye on this sector. I do think REITs will continue to perform as long as they are invested in the right place. The refinancing risk of this market goes down as rates drop down. So when you see mortgage rates come down, you're also going to see commercial real estate adjustable rate mortgages, ARMs for 3, 5, and 7-year fixed periods come down incrementally. And if that does happen, that will soften the refinancing risk in this space a little tiny bit. Mega caps will move a whole lot based on how this bad boy reports today, Nvidia. And since we have the capabilities, it makes all the sense in the world for us to look at 2 different views of Nvidia. And I think the most important one that we're going to do here is going to be today's chart. We'll take a look at the stock chart for Nvidia. It is up 1.48%. It is near session highs here, and this is intraday real-time trading. So I think what this is basically telling you, and the market believes that the results from Nvidia today will be positive. And if you believe that, then you know what? Good for you. I don't think there's any reason to think that it will be negative. Let's look at it over the course of a little bit broader period of time here. Let's look at it over 6 months. You'll probably be happy with those numbers too. There you go. So again, approaching highs here over the course of the last 6 months. So let's look at it as of 1 year. I think that'll probably give us a little bit more perspective on the height. But you'll see a pretty interesting trend at this particular juncture. There you go. So this is Nvidia over the past year, up 51%. It has really been pretty much a highlight run here. And this was the all-time high, I believe, and we are approaching that currently here. So there seems to be no backing off, and the market seems to believe that the numbers will be positive. And I believe they will tonight when they release earnings after the close of the bell. And let's go at one more chart, because Nvidia is actually trending on our XAI view here, because of course everybody's eager to see what is going to happen. This is the trending analysis from XAI. This is telling us what Nvidia's Q4 earnings are anticipated. High anticipation for Nvidia's quarterly earnings report after market close, with CEO Jensen Huang expected to provide key guidance on AI demand and future outlook. I would suggest watching these comments on this, I think this is going to be a meaningful movement in the market and should be very bullish. And as you see here, the sentiment on social media is very bullish. The mentioned spike of Nvidia is up 280%. Engagement is high on this topic. Volatility is high into this topic. And there is an elevated risk level for the tech sector here. AI's breakdown, again, not mine, not Saeed's. Despite bullish sentiment, Nvidia's 1.99% pre-earnings move suggests expectations may already be priced in, creating downside risk if guidance disappoints. I do not believe that'll disappoint, but that's a pretty astute observation. Seems to be a very divided sentiment on that particular conclusion. I am in this camp here where I have a pretty strong consensus that things will be okay. But hey, don't take it from me. We got a forecast model for this, kids. I know. You're thinking, what? These guys have models? These guys do smart stuff? Every once in a while. We're not complete and total idiots, but you know, I'm not the smartest kid in the world. Here you go. This is Nvidia according to our outlook forecast model. So because of the synthetic volatility index, you're seeing a positive attribution here. Durable goods orders on Monday in 18 hours. We always have anything that's coming up in the calendar, which we showed you early in the show, as a macro data point risk that inherently affects the model. Now keep in mind, it does affect the model, but because it's an inherent macro data point, which is likely not to impact this particular sector, I think you can discount that a little bit. Liquidity Pulse Index still continues to show that the Fed liquidity is draining from the system, and as a result of that, this is not a strong recommendation to purchase at this particular height. This topic, as you noted here, is in fact trending. They're saying this should be in your watch category or setting up for a trade in and around that space. There are macro event risks and there is single event risk. The symbol's got great performance and the market seems to be performing positive today. So if you were looking at this from a hedge fund perspective, they said the trade would be allowed, but be cautious. You would be buying shares, not options up or down, okay? This should be a short trade if you're looking to do that. I personally think it should be a longer trade if you're going to hold long. This should not be less than 6 months to a year, frankly. And the risk level here is slightly elevated due to macroeconomic factors. Again, I think these are not significant factors. I think if you're going to buy this and hold long term, we can do that. But what this is really saying, and I'll break it down very simple here, is that this is near all-time highs. You haven't seen a dip. Let's go back to the stock chart and I'll explain this a little more with visual acuity here. So this is over the course of the last year. It's a 1-year chart, right? So what they're basically saying is you're near all-time high here in the last year. Right now is a cautious time to buy. If you believe in this for the long term, which is why I say 6 months or longer, then so be it. But if this were dipping back down into this territory where it has been in the not too distant past, then I would say it's a more stronger buy because you've got more upward mobility here. Right now you're buying for future growth. There's only downside risk in this market is essentially what this is saying in the modeling, if that makes sense. I will pause for comments. Does anybody have any questions? We haven't really gone into the forecast models a whole lot on the show because I've been trying to be a little bit more systematic and patient around using it to make sure that it works. Anybody out there want to talk about it or have any thoughts or comments on what this actually looks like? Who's the Baroon guy you guys mentioned in the last episode? Danny 400. Arun, Haroon, who used to be Regil. He used to be the guy on the production desk where I'm standing right now while Saeed and I were in the studio over that way. Bringing everything up in the show. He had his third. He had 3 under the age of 3, and making the show to record with us in the evenings just became a logistical nightmare for him. So he kind of bowed out to give us the opportunity to bring somebody else on. Saeed and I were going to do it on our own. And when I built this place, Regil came and actually helped me build it physically with all the construction that we did here. We spent a lot of time together, and he's been a great add to the show. So he actually runs the production and all the producing of the show in real time whenever we do the podcast. So that's who everybody is talking about. Let's get back into the sectors for a second here. Market leadership seems to be strong from the Mag 7. I think this is largely in response to what the market believes will be a good day, but it isn't just Nvidia. Everybody seems to be pacing around the same. Microsoft as well too. Let's jump in to some other sectors here. The consumer sector is one that we believe in strongly still, despite the fact the market shows us down. Walmart is coming off of what I think is a high period of time. Target, Costco, Home Depot, Dollar General. I'm still a big believer in these stocks. I'm going to weave in a little bit here of some chart work because I think it's important to look at how these are performing a little bit. So let's go over here to Walmart. I think Walmart, and I'm going to look at it on the 1-year perspective first, is a good buy still. I think consumer discretionary spending will pull back, but this is where people are going to start spending more and more money, particularly the wholesalers, if you will. Let's look at this over the course of 5 days. I think they had a bump a couple days ago. Yeah, there you go. So you dip down, you saw a bump. Now you're seeing a little bit of stabilization. I think this is still a good buy. My personal humble opinion here, and I think the sector in particular in consumer health is going to continue to perform. Not because consumers are doing well financially. We have 12.7% credit card delinquency, 90, 60-day plus or 90-day plus delinquency, and you have all-time high credit card debt. That being said, let's discount it and let's go back to the ideal concept here that as times get tough, more spending happens here, less spending on the luxuries, if that makes sense. So that's kind of my philosophy and my belief. Take it with a grain of salt. I'm also an idiot. Let's go over the industrial sector. I think this will continue to perform well, particularly if tariffs are successful. These are the real economy signals. Deere just had a nice little bump because they announced earnings that were better than expected, and we saw them really take a leap up. And I think the market is just bringing them back in line with what I would call coming off the hype. Let's go into that chart as well. There you go. So Deere & Company, last 5 days, taking a bit of a dive down. Let's go back 1 month here. There you go. So very different perspective, right? So if you look at the 1 month, they had better than reported earnings right there. And then what happened is you get a situation where the market gets overexcited and then starts to come back to reality. But what happens is, and I'll use this chart as an example of this, is that if you zoom in on this stuff, and we can do that right here, we'll go into a 1-day chart. There you go. This is the 1-day chart. There's lots of peaks and valleys. You see these? Lots of peaks and valleys in there. And these peaks and valleys, as you look at it over the course of things, and let's use some other tools here that I have. If you look at these peaks and valleys here, and you focus on the ups and downs throughout the day, this happens as well throughout the month, throughout the year, and you got to keep an eye on the wider trend, which is often why you'll see me go wider out to try to show you what's really happening. Because if you look at this chart, you go, oh my God, it's trading near session lows. This is really scary. Some things to think about here. Current price is 626. It got as high as just under 650. It's around 631. You're not day trading if you're watching this show, most likely. And if you go to the 1 month chart here, and I'll back this up a little bit, you see a very different trend where it seems to be leveling out a little bit right here, right? So I bet you right where it winds up settling is somewhere around that mark there. And then you start to see it either flatline or continue to grow based on their deliveries to the market. I think it may slow, but if we are successful with tariffs in bringing business back over the long duration, tariffs in theory should work to boost local markets in the industrial sectors, which this is a part of. Does that make sense? All right, so if you have any questions, feel free to bring them up. I can't bring them up on screen this particular show. I'll figure out why. Geopolitical supply risk continues to be a bit of a pain point right now. I think with the military moving to the Strait of Hormuz and the potential threat of Iran out there, you're seeing some exposure and some pain points here. You also have what appears to be a really dire set of circumstances for Mexico right now. Guadalajara and some of the cartel members out there are seeing some really scary things, and as a result, that geopolitical unrest does affect this sector, whether you like it or not. So I think you're going to see some bearish positions in this space for some time. The defensives, these have been our shining star. These went up during when market went risk off the other day, and this thing dialed back. We saw all of these guys boom up. We do feel confident this model is working, and these are in fact your current capital preservation stocks. We were thinking about swapping some in and out, particularly the energy sector, because of their exposure to the tech sector. But for right now, our capital preservation numbers are Procter & Gamble, Coca-Cola, Johnson & Johnson, NextEra Energy, and Duke Energy. When people are fleeing from the market, going risk off, this is where the money should, in theory, go. Does that make sense? Cool. All right, I'm going to go over here to Instagram, see who's out there. Oh, there's lots of comments. Hell yeah, CME Group. Yeah, what up, Vic? Sorry, I didn't see your comments earlier. How long have you been doing these lives for? I'm going to have to set up notifications. What up? We do the lives Monday, Wednesday, and Friday at 11. We kind of soft launch them because the lives are not really about the entertainment value here. These lives are more about giving you everything you're going to get on CNBC within a narrow window of time, about an hour. We wrap in things that CNBC and other programs don't include. We're still giving you the real-time ticker down below, but what we're also giving you is a look at some of what's going on in the social media sphere. Behavioral economics and the democratization of the space vis-a-vis Robinhood played a meaningful role here. So what we're trying to do is give you everything that CNBC would give you in a full day show, truncated in an hour with the social narrative in addition to that, Monday, Wednesday, Friday at 11. They don't stay on the YouTube because the algorithm penalizes us for a lack of longer viewing. So if we put out a show for 8 minutes and somebody watches 5 minutes of it, you get a lot of absorption of that. The algorithm rewards it. If you put out a show for an hour and somebody watches 30 minutes of it, you get penalized for that because they're just not consuming as much of your content in the algorithm. And that's unfortunately the way YouTube works. So we stream these live to YouTube and they come off YouTube immediately afterward just to keep the algorithm going. If you want to see a permanent kind of repository, you can go to LinkedIn events on my personal channel, or you can go to X as well and see that there. I'll go over to let's go over to the XAI model. For those of you who are not familiar with this is the model we talked about Nvidia earlier on. And this is our proprietary model. It's going out to Instagram, it's going out to X. And this particular is driven by X in this particular instance here. And what it's going to do is it's going to pull the rhetoric that it's seeing here and give us a profile. The other trending topic, number 2, Trump's AI infrastructure. Major tech companies, including Amazon, Google, Meta, Microsoft, XAI, Oracle, and OpenAI are reportedly set up to sign agreements with the Trump administration to generate their own electricity for AI data centers, which would solve the AGI, where is the power coming from rubric. And we already knew that some of the larger companies in this space had already been seeking permits for nuclear power. So how that affects, and I'm hoping that there's some give back to the consumer so we are not paying for data center usages in our electric bill because supply and demand issues cause the value of that to go up. Look no further than what happened in Pennsylvania for that. The infrastructure partnership could create massive utility and energy sector opportunities while reducing regulatory overhang on big tech AI investments. And that is why we've been a big believer in the energy sector, and we continue to be. Despite the geopolitical unrest, I think that this is going to be a huge push. And if you believe in tech being the future, you have to believe that this is going to have a positive impact there. Bitcoin surging above 68K this morning. I think it's back down a little bit as we started the show. Let's take a look one more time because it's been a while since we looked, and Bitcoin moves fast. Go over to crypto here real quick. Yeah, it's about 68,848, 835 as of right now. So take a look at that real quick before I jump back over to the XAI model. There you go. So 68,835. So still above that. Bitcoin's break above 68K coincides with institutional AI partnerships, suggesting crypto could benefit from increased corporate treasury diversification. Yeah, so I think that's probably a fair statement by AI. And what do I know? AI is a genius here. And of course, the absolute, interestingly enough, the next topic here, AI bubble sparks risks. AI bubble risk in bond markets. Bank of America Global Research Survey shows that AI bubble is now seen as the top risk for bond investors for the first time ever. Yeah, makes sense. AI hasn't been around for more than a couple of years. So yeah, it should be pretty interesting. And I don't think this is limited to the tech sector. I think this is limited to the entire macro economy. Look, like it or not, this entire economy, this entire global economy, not just the US, has exposure to this, meaningful exposure. And we have all bet, maybe an educated, informed bet, we have all bet on this technology having meaningful improvements. The dollars that would have gone into this from CapEx, if they are not returned in the form of efficiency, you have a fundamental problem for profitability in companies that will have impacts that are dire to the market. Bond investors' AI bubble concerns could signal smart money is already positioning defensively while equity markets remain euphoric. I think that is 100% true. And I think it's part of the reason why the biggest shining star, at least in my mind, for the next year will be the other 493 stocks, not the Mag 7. Not to say the Mag 7 won't perform. I think you're going to get more upside potential from the other 493 stocks. Certainly the QQQ will do well and outperform the S&P 500, but I think unlike this weighted Mag 7 to 10-ish stocks that we saw last year, I think that weight is going to come down a little bit, and you're going to see the other 493 continue to perform in the small cap sector, my humble opinion. CME trading halt. This is interesting. CME Group's Globex metals, natural gas, futures, and options market experienced trading halt, causing concern amongst commodity traders. Technical glitches at major exchanges during volatile periods often signal underlying systemic stress and could precede broader market instability. And this is one of the many reasons why on, for example, the market status, we use the ETFs because they don't have halts like that, whereas the indices do. So we have a real-time fluid number here. These do move in the same percentages, but they do account for things like real cash flows, derivatives. And there's a lot of people who argue that point and they don't like ETFs for this as a proxy. We just happen to prefer it for all those reasons. You may not, and like I'm open to all arguments, but that's kind of what we work for here. Just a couple more here. S&P 500 recovery above AI crisis levels. S&P's come back a little bit. Larry Summers' Harvard resignation. Now this one caught me by surprise. Reports indicate Larry Summers is set to resign as Harvard professor following connections to a recently released Epstein files. Yeah. Larry Summers, very well known in the economic space, which is kind of surprising. Summers' departure removes a key policy voice, potentially shifting Fed succession speculation and reducing hawkish academic influence on monetary policy. So to see him pivot there was a bit strange for sure. And then, of course, the last one in the AI rhetoric that's coming from social media, not us, is the housing market data analysis. Detailed discussion of housing inventory, data methodologies, and new listings as key indicators for detecting market stress before other data points. I love that that's a trending topic. AI's statement here, focus on new listing data as early warning systems suggest housing analysts expect potential credit stress that hasn't showed up in mainstream metrics yet. And a lot of that came from Uncle Jamie Dimon, who came out and said the other day that he believed, and I'm actually just gonna pull the article up here. Jamie Dimon, 2008 similarities. Oh. He made a quote, and I'm gonna bring it up on the big screen. There you go. Jamie Dimon warns market resembles pre-financial crisis era. I see a couple of people doing some dumb things. End quote. That's meaningful coming from Uncle JD. That means something, right? JP Morgan Chase CEO Jamie Dimon said Monday that the financial world looks a lot like the heyday in the years ahead of the global financial crisis. And I'm quoting here, unfortunately, we did see this in 05, 06, and 07, almost the same thing, Dimon said at the firm's annual investor day in New York on Monday. Okay? The rising tide lifting all boats, everyone was making a lot of money, people leveraged to the hilt, the sky was the limit. My own view is people are getting a little comfortable that this is real, these high asset prices and high volumes, and that we won't have any kind of problem whatsoever. So we're quite cautious about that, Dimon added. Dimon's comments come amid a turbulent market period as investors have dumped stocks across a range of industries over fears that artificial intelligence will disrupt their core businesses, and it will. In the financial industries, these challenges have been mostly acutely felt in private credit markets, but I think they will be felt in the banking sector at some point in time too, because the banks make something known as C&I loans. As a matter of fact, most of the small balance C&I loans are coming from the banks, right? Think about it this way. The banks are in the business of making money by giving out money in the form of loans, right, at a certain interest rate, let's just call it 5%, and giving out and taking your deposits in and giving you interest rate fee for that back. Let's just say 2%. 5% minus 2%, that is your net interest margin. 3%, that's the bank's profits. Obviously, somewhere around 2% to run an institution if you're using approximate numbers. That leaves you about 1% profit. That's how banks make money. Long story, really, really short. Now, the way you incentivize people to bring deposits to you is you offer them treasury services. You offer them a value proposition of service that makes them feel loved and warmed. But of course, as you look around and drive around your economy, whether you're in Oklahoma, you're in Texas, you're in New York, you're in California, here's what you do. You drive around, and whenever I'm looking at the screen, here's a teleprompter right here, which I don't have on because I raw dog this with you. But then I look at this on the screen, and I don't know if it feels like I'm looking down or looking at you here. Just tell me which one you prefer. In any event, as you drive by any city that you're in, you see businesses. Those businesses all have deposits and at the very least operating accounts, right? As those businesses struggle, those deposits, which banks rely on heavily because there's usually more in those accounts than there are in consumer accounts, tend to draw down as they see to have financial strain. As they draw down, they have less liquidity to make loans. And yes, there's a way you can leverage loans to get more liquidity to make money and so on and so forth. And you've seen this leverage in the system over time, and it's healthy and just normalized accounting, despite the fact that it's demonized. Here's a problem, right? As this liquidity runs out, if there's there's pain points in the system to small businesses, to private equity, this will affect the GSIBs and the larger banks over time. Now, I think that their credit perspective here is not the risk. I think their liquidity positions being impacted is a bigger risk, which is why we believe the GSIBs are stronger, the globally systematic important banks, versus community regional banks. As community regional banks have trouble, they're going to sell, hence the reason why we believe that M&A activity is going to pick up. They're at a point where profit margins have widened again, post the contagion period in banking, and vis-a-vis this, you're going to see banks M&A activity keep up. You can see a lot of the senior executives from banks leave and retire at this particular juncture who had been waiting to do so a couple of years ago. And you're going to see the GSIBs pick up a lot of smaller players, and that's how they're going to get their excess deposits. They're going to buy banks while other C&I small businesses are shrinking, limiting their liquidity position. I know there was a lot all at once, but if somebody has any questions, I'm always here to answer them, or you can email us at media@higherstandardpodcast.com. Let's see what the comments say. I haven't been watching them. I'm a terrible, terrible host. I apologize. I don't think the Restream chat is working again, although I haven't seen a whole lot here. Let's see on the YouTube, Instagram side. Corey, what up, bro? Let's see who else we got. Zane out there. We got Jack. How you doing? Merdad, what's up, my guy? Vic, of course, always showing support. I haven't seen Samson. Usually I see Samson every single day. Look at that. Look at that. Every once in a while we get a different demographic. All right, so let's finish this up here by going through a little bit of the social stuff here. I think there's some important stuff that's from a narrative perspective that's it's worthwhile to talk about. Uncle Jamie Dimon laying down the smackdown. I'm going to go to the social media view. This is X. And, you know, when Elon Musk posts a meme, you got to pay attention. Breaking news, hackers use Anthropic's Claude to steal 150 gigabytes of Mexican government data. His response, it's gone. So mature. Carl Quintanilla. I can't say his last name, but he's on CBC. He's one of the hosts. He is such a buttoned-up dude on the show. I didn't realize this until I started getting more engaged on X. My man is a gangster on X. I have a whole new respect for Carl. Shout out to you. You're never going to see this, but if you did, I love you, bro. This is awesome stuff. The UBS report on higher income workers worried about their jobs is getting some pickup. Yeah, top earners are more afraid for their employment than lower income as AI threatens to increase. Yeah, why? Smarter than you, bro. Smarter than me. Smarter than everybody already. But let's just go down some of the profile stuff that I have here. I'll break you down a little bit of this from just a mathematics perspective. This is wages. I'm going to go to the bigger screen so you guys can see it. All right, the gap between productivity and a typical worker's compensation has increased dramatically since 1979 to now. Now, what I'm going to point out here are some details, and I'll let you be the judge of what this actually means. From 1959 to about 1979, that portion right there, okay, you saw a pretty healthy connection between corporate profits and how much we got paid, right, as employees. Well, in 1979, the average productivity crept up pretty significantly. And at some point, you go, okay, technology, infrastructure, all good. But here's what I mean by wage inflation hasn't kept up. Companies are making more and more. I think 16% to the bottom line is the average number. God, my writing is so bad on this. I apologize. But meanwhile, you got wages, which is seemingly flatlined. This is part of the housing problem. This is part of the market problem. And if you think AI is not scary and isn't going to impact this, I would say the job numbers already say it's impacting this. Yes, recessions aren't AI driven right now, but you're not seeing the same hiring activity that you once saw because people are eking out efficiency. And this chart shows you exactly where it's coming from, right? Productivity growth and hourly compensation from 1948, not to 1959, I apologize, to 2025. So productivity increased by 1.4%, right? Compensation increased by 0.6% during this time. However, in this time period, productivity went up 2.5%, even more, but we also saw a 2.1% compensation increase at the same time. Now, I know that's discouraging, but the numbers look small, but that's a big gap, right? Companies are making twice as much as the employees now versus they were making incrementally more here, where companies are just making more. They are making more profits because the market demands more profits quarter after quarter, year after year. And you know where you're getting part of that money from? From us. And it sucks. But unfortunately, that isn't the end of this narrative. There is more to the story. Here we have a disconnect between productivity and typical workers' compensation 1948 2014. And I want to point out the distinction here. So this chart here goes all the way to 2025, and this one goes through 2014, which is more of a dense look at this. So this view with 11 years less gives you a little bit better of a picture of the widened gap. And again, this is 2014, so this has only gotten worse since then. It hasn't gotten better, as you saw in the previous chart. But to break this down, productivity here between 1948 and 1973 up 96.7%. Hourly compensation 91.3%. So again, very similar to the other one as far as very close symmetry. The disconnect here all the way from 1973 to 2014, different dates, but still same concept, 238.7% versus 109%. So more than double the productivity for the hourly wages. And you can see here, this just goes to show you how flat that number really is, right? That's a board, man. That's lying down. That ain't good. Remember planking? Does anybody still do that? That was great. Anyway, let's get back to the X page here, and I can show you some more details as we go through a little bit more and more. I posted a lot on some of the platforms recently, so don't be overwhelmed by the fact that I'm rambling over and over again. I got a lot to say. Carl talks about unemployment fears for the top third and shows a graph and chart here, which I think is probably something that I'll share a little later on. Bitcoin being back above 68,000. Oh, JP Morgan CEO has warned. Who's this, Bloomberg? Yeah, we're going to listen to Bloomberg. You guys ready? Here we go. Let me get the volume on here. See if I can.
I see a couple of people doing some dumb things.
JP Morgan CEO Jamie Dimon has warned that some banks are repeating mistakes from before the 2008 financial crisis. His fears are well-founded. Even though corporate bond markets look calm and credit spreads are near historic lows, the structure of the market has changed in ways that will matter in a downturn. Before 2008, banks and broker-dealers were the dominant price makers in corporate bonds. They held large inventories and used their balance sheets to stabilize prices during periods of stress. Since then, regulation and higher capital costs have sharply reduced their inventories, even as the market's grown to roughly $16 trillion. ETFs, on the other hand, have expanded rapidly. They now hold substantially more corporate debt than US banks. But ETFs are price takers. They would reinforce any downward moves, potentially turning a sell-off into a rout. There is no shortage of catalysts that could cause credit spreads to widen, from massive AI capex to private credit loans to software firms souring. The realization that the credit cycle is turning could trigger a rush to the exits. Investors, however, might find they can't get out nearly as quickly as they'd like.
Okay, a couple points to note here. Number one, Saeed, you got some challenges for the quarter zip king. My man's coming in hot for you. Oh, this way, coming in hot for you with the quarter zip. Let's just highlight what that is. It's just real. Number two, you spend all the time to be using a teleprompter and something like this, my guy. But nobody said, you know what? There's some echo in the room. We should probably solve for that rubric. Or hey, run it through Adobe Podcast and let's just get that echo out of there automatically using AI. Come on, guys, y'all. I should not know this and be better at this than you. I mean, that's not how this works. And yet the sick part is the algorithm rewards content like this more than they do content like this because I'm considered too produced. I'm not complaining. I'm just, I'm complaining. Yeah, I am. I'm complaining. You know what? That's fine. So let's get to it. His accent, by the way, was sensational. Shout out to that guy. So yeah, you're seeing some continued stress on the markets and the narrative that Jamie Dimon, when he speaks, you got to listen. Google searches for "I can't sell a house." This made the news all over the place. I did not repost this because I don't think this is material enough for us to really point to. But I can assure you that if you lower the price on a house, you can sell it. But effectively, Google searches for "I can't sell a house" or "can't sell a house" just recorded record highs. That's a circumstantial piece of evidence. I don't really know that it's 100% clear. It's a noteworthy thing. But to me, the social rhetoric around that is not meaningful enough for me to be concerned. Oh, Brian Moynihan, CEO of Bank of America, saying something. Bank of America's CEO, Brian Moynihan, has said interest rates will continue to decline, calling the trend very constructive. Okay. Brian Moynihan sucks, okay? I don't know. And the sad part is like CNBC positions him as like an economic genius. And maybe he's right this time. But he's been wrong a lot. Like tone deaf wrong. Like when we were coming out of the stimulus, economic stimulus period of the pandemic, and people were spending all this excess reserve they had, and we could see the stress in the system, he went on CNBC at a conference and, very deliberately said that he believes the consumer is strong, that his people are telling him that they have more savings than ever and everything was great. I don't think so. And as a matter of fact, the current evidence suggests quite the contrary. You got student loans at the highest default rate in history. You've got 12.7%, the second highest credit card default rate in history, second only to the Great Recession, which was 0.4% higher than the current default rate. And I think we're going to be at that the next time they report that anyway. You got highest non-household debt balances in history. And yeah, there's equity in homes, but most of America at this particular juncture in time is struggling to either sell or buy a home. And as the Google search here seems to evidence. So again, this is a very tone-deaf man in my experience historically. Now, this statement is not tone-deaf. Bank of America CEO Brian Moynihan said interest rates will continue to decline, calling the trend very constructive. And maybe it is near term. Long term, however, I don't believe this solves any problems. I think you can't have your cake and eat it too. I get that the president said on the State of the Union that he wants to keep values for the older demographic, who, again, his primary constituents who got him in place, the voting majority is an older demographic, all good. I get the narrative here. The home builders also helped getting him elected, was part of that. I'm not here to judge anyone's politics. I get that you want to keep them having equity, but at the same time, you want to find a way to solve the affordability crisis, and lowering rates will just drive values up Again, it's not going to solve that rubric, which is a big problem. The average age of a home buyer in this country is 40 years old. Average age of a new employee is 42 because people are going back to work. You just can't ignore the fact that we do not have a meaningful solution to this long term. Near term, yeah, sure, lower rates will help, I guess, put some grease in the wheels of the market a little bit. But is that the best thing for us, for our children? No, absolutely not. Who's thinking about the kids? I don't know. I really don't know. And it bothers me. Bothers me so damn much. It bothers me so damn much. I apologize for the rants. I joined late because of a meeting, Corey, but still made it. Yeah, bro. What's up, Fancy Faces? How you doing, girl? Yeah, no, look, you didn't miss much. I've been ranting a little bit and pissed off at the world, but you get the point. Let's see what else we got here. Macro Edge, one of my favorite pages on X. Here we go. I love it. I love this this page. If you're on X and you want to follow somebody, Macro Edge should be your first follow. Jamie Dimon says, watch out as extreme asset prices add to economic risks. My anxiety is high. Again, Jamie Dimon making more comments. This is crazy. Bitcoin up 9.2% since Tariff filed lawsuit against Jane Street for market manipulation, something we will cover on a future show, probably the one coming out next Tuesday, but I got to figure out some more details on that before I talk about it publicly. Not only that, the daily 10 a.m. slam has also stopped. BTC is rallying alongside stock market. Basically, they're accusing them of market manipulation and the price of Bitcoin. There's two particular waterfalls in value, which brought Bitcoin's value down, which they think may have been manipulated. So because of that, they're suggesting that you're seeing a 9.2% jump in the price of Bitcoin rising back up to suggest that it was artificially deflated for manipulation purposes, which is a whole wild conversation. And I know the cryptocurrency pundits will say that that's great. We figured this out. We solved the problem. We can now go back to the moon and diamond hands, that whole thing. But I would argue that really the ability to manipulate that is a problem, frankly, to me. And I think it should be everybody. So that's just food for thought. Okay. And if you want, here, let's just show the chart anyway because we're here. This is a trading view chart of Bitcoin's price. And if you look here, there is Jane Street's lawsuit being filed right there, but see these trading waterfalls here, down, down, down. The suggestion is that they were manipulating the market, and when they stopped doing that here, you saw this flat line a little bit, and it's crept up and up and up every single bit. So, line. That's technology I never use in the show, but just so you know that I can do it. So yeah, I think that the argument is that you're going to see a rebound back up in time. I don't know that you will. I don't know if that was the main driver of this, but certainly fascinating. To me, that causes me a great deal of concern because nobody should be able to manipulate currency or currency adjacent equivalent, i.e. Bitcoin, so easily, frankly. Now, of course, who would I be to not go over my guy Lance Lambert, who I like. A lot of people are critical of him. I don't know why. I listen to all opinions. Big banks retreated from mortgages after the 2008 housing crisis. Now the Fed governor wants them back. After decades of, quote, migration towards non-banks, Federal Reserve Vice Chair Michelle Bowman says it's time to reconsider policy. Yeah, except here's the problem. Big banks did retreat because the big banks have the obligation to underwrite under the Dodd-Frank Act. There is the ability to repay rule, the ATR rule, if you will, and this puts stricter regulations on banks from a compliance perspective, which are enforced by the regulators. I would say the enforcement of these rules, not necessarily, the rules don't always apply one-to-one to non-bank lenders, but they're certainly much stricter on banks than they are non-bank lenders, which is why you saw non-bank lenders fill the gap there. Not to say that anything's wrong with Rocket Mortgage and Loan Depot and the likes of them. They've certainly picked up a lot of them. I have a great deal of respect for lenders in this space. They provided a very essential need for the community, and that's great. But if you want to see banks back in this space, it comes with less regulation or, I guess, loosening the rules, if you will. And I'm not advocating one way or the other. I'm just telling you what stopped it and what changed it. And look, banks are in the business of making money. If you give them the opportunity to make money, they will. It's that simple. So, all right, let's leave the show there. We've been a lot today. I think I've done a lot of yammering on, and a lot of it really, really fast. So I know there's a whole lot of dense information. But the idea is to give you as much as I can, as quickly as I can, so that you don't have to watch CNBC all day long and you can just look at my face. Although Carl Quintilla, man, whew, straight gangster on X. If you haven't checked that out, check that out. For those of you who watch the show, I appreciate you beginning to end. It means a lot to me and to Saeed and the rest of the boys. If you want to help us, you can always go to thspod.com, get some merch there, supports the show. But go to Fridays, go to joinfridays.com, use code HIGHER. You get $100 off your first order. GLP-1, microdosing GLP-1, regular usage, longevity stuff. I use the NAD+. It's great for you. Until next time, everyone, we love you. We appreciate you. Okay, bye.